It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the CFPs on the program. It's been a while, but man, it's great to be with my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
Well, it's safe to say that the stock market has surpassed just about everyone's expectations for the first half of 2024. So what's caused the strong returns, and what should investors expect for the second half? That and more coming up on this hour of Wise Money.
Voicing in for Kevin today, Barry Manilow. Kevin's got the middle of the summer sickness, which if you're feeling that too, I feel bad for you. Poor guy is miserable, but we're happy to have you in the studio, buddy.
Well, I'm happy to be here, and when I'm not feeling well, I try to make sure no one else does.
And everyone knows. All right, so there we go. Hey, if you have a question for the program, we'd love to hear from you. We're going to be talking through questions that you're probably having right now on the overall stock market and investment theme, so we're going to hit that. You can call or text us, 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us, submit questions there as well. And then all over social media, wherever you're at, we are there as well. Search The Wise Money Show. There are 6 areas to your financial life. I'm going to say that again. There's 6 areas to your financial life. The reason Korhorn Financial Group exists, the reason the Wise Money Show exists, is to preach that message. Well, Wise Money to preach that message, KFG to serve you in those in those disciplines. Investment planning is one of those 6. It's not the dominant one, though. And if you are working with a financial professional, or you yourself are managing your investments and you're thinking, I'm doing planning, you're not. You're doing 1/6 of the planning. It's important, but it's not financial planning in and of itself.
That's exactly right. And you also can't count on your investments to do all the heavy lifting for you towards your financial goals either. You know, sometimes people, they under-prepare for long-term goals like retirement, and they get closer and closer to that goal, and they need their investments to outperform or, you know, make up for some ground that they didn't cover themselves in their planning. And that can put too much pressure on your investment portfolio. It can give you unrealistic expectations. Ultimately, it can lead to some mistakes in your financial life if you just focus on the investments and the performance as your way of reaching your goals.
Dollars could be slipping through your fingers going to Uncle Sam that should instead be staying in your portfolio, staying in your pocket. You could have poor risk management, not have a will done, all sorts of things. So you need all 6 areas working together, and you need a CFO, a CFP, that is sitting at the intersection helping to make sure all of those areas are working together as you make big financial decisions. All that to say, we are going to focus on the investment world today. This is a habit, a pattern of ours to around the halfway point of the year to tune into the markets and say, all right, well, where are we at? And what's driving all of these returns, and how do you need to recalibrate for the second half of the year? Guys, markets move quick. We are recording this around the midpoint of the year, and I think it's safe to say, by anyone's expectation, the market has surpassed, the S&P 500 has surpassed expectations. In fact, Wall Street firms, which chase their tails and try to do forecasting, they're all chasing their tails saying, oh, we're going to update our forecast. We're going to update our forecast, because the S&P 500 has already exceeded almost every Wall Street expectation for the entire year, and we're halfway through.
Well, and that's also coming on the heels of outperforming expectations last year.
Right.
Last year was this huge performance by the, at least U.S. stock market, caught a lot of people by surprise in a good way. But then, you know, after a nice, strong run in the market, a lot of people think, well, we're due up for another pullback, or don't expect that again this year. And here we are, you know, the U.S. stock market up, you know, strong double-digit returns already this year.
My favorite chart is okay, so geeking out for a second, JP Morgan Guide to the Markets. I don't know if I'm allowed to just say that. It's a free resource out there. But they update this slide deck, these charts, in it's like Christmas morning for for a financial geek. And
well, they update it every day. How often are you checking it?
Hey, I keep getting that hit. Like, it's Christmas, it's Christmas, it's Christmas. No, once a month they really update it. Once a quarter they really update it. But you can peek behind the curtain actually on a daily basis. But anyway, in that slide deck, they made famous this chart that shows an intra-year drawdown. So from a high point of the year to a low point of the year, how much did the stock market decline? And then they overlay that with, well, how did the market finish for the year? Mm-hmm. And they have that going back to 1980. The average from a high point to a low point drawdown is about 14%. So you should expect a 14% decline every year. Let me say that differently. If you've got $1 million saved up, you should expect at some point to see your portfolio down 140 grand, and that's average. Now,
that's just at some point during that calendar year.
Correct. And so, but here's the thing: out of those, 44 years, 30 end up being positive for the year. So a large percentage. Just be patient and focus on the horizon, and the markets will perform for you. History shows that. But in the short term, expect volatility. All that to say, I know I used way more words than I needed to. The drawdown this year has only been about 5%. Mm-hmm. So we're nowhere close to that 14% average. Will we hit it? I don't know. But yes, Josh, I do think a lot of people are expecting a pullback, a correction, and I would encourage you at all times to expect that.
Mm-hmm. I love that chart because it gives you some hope that just because the market might be down at some moment during the year and you're feeling like, okay, if this trend continues, my goals are so off track, I'm so done here. But as you said, the markets can move quickly. They can change direction rapidly. Going back to last year, for example, the stock market was down 10% at one point during the year. And if we had just drawn the line on the calendar and flipped the page and we were into 2024 at that point, it would have been a negative year. You would have been upset. The year ended positive north of 24%.
Yeah. That's wild. Thus far, year to date, the U.S. stock market, large cap stocks, let me say that. Large cap stocks are, again, leading the charge, up double digits, almost 15%. Emerging market equities are sort of trailing, but they're in second, not up double-digit returns, and same with international. So we have yet another year where U.S. stocks appear to be outpacing international. Now, the other tricky thing or interesting thing is a lot of people expected small cap and mid cap stocks to start surpassing or outperforming large cap this year because it seems like if a new bull market started in the fall of 2022, we're still early on in that bull market. And typically bull markets are led by large cap and then they're sustained by small and mid cap. And so just based on, historical or just assumptions, small and mid should be picking up steam. And they did for a pocket of the first quarter or first half of the year. But no, they've lagged.
Yeah, they're essentially just at a break-even point for the year.
Yep.
Think of them as flat for the first half of this year. Now, that doesn't mean that those trends or those assumptions that Mike was referring to don't play out for the rest of this year. Because, again, these asset classes or these categories of investments, they can change their performance rapidly, positive or negative.
Yeah, bonds also, let's call those about break even, which is, so bonds perform like a teeter-totter to what's going on with interest rates. If interest rates are going up, bond investments are going down. And listen, interest rates went up. My goodness, did they go up quickly in 21, 22. And so bond investments went down. And we haven't seen interest rates come back down yet. Therefore, bond investments haven't come back up. And all that to say, if you're in retirement or if you're holding a lot of bonds, you are still way below that high water mark and could be frustrating. We're going to talk about what's driving the markets, what's driving that, and maybe if that will change. But bonds thus far year to date, total return about flat. You're earning more in cash and money market or CDs than you are in bonds. So that's where we are approximately halfway through the year. We already mentioned that doesn't mean, markets change quickly. Doesn't mean that's where we'll finish the year. And by the way, you probably didn't know this, but there's an election waiting for us later this year that certainly could be driving the market. But what themes have driven the market thus far? What's driven this performance? What should you expect for the second half? What adjustments should you need to make? All that more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning, also on podcast at the same time. But the reason why the content's broken up the way that it is as long as it is a talk show that airs on a couple local radio stations where we're at, and we just turn the cameras on and give it to you as well. But in addition to that, right here on this YouTube channel, we have Next Wise Step videos that are designed just for you, 10, 12 minutes long, taking one financial concept, applying it to your financial life. So make sure you hit that subscribe button, turn on notifications if you like the content, share it as well. We appreciate it. And leave questions below. Yes. Kevin?
Yeah.
Yep. I didn't want to put you on the spot, but I'm going to because you...
No, that's fine. Dude, I'm falling completely apart. So
no, we got you. Okay, so what themes have driven the returns? I think that's where we could talk about the market being top heavy, equal weighted versus cap weighted, all that stuff. Mm-hmm. All right, segment number 2. How much of the market performance this year or even last year has been driven by just a couple of stocks? Is the market getting so top heavy that it now is a risk that you need to manage? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, go check it out. Search the Wise Money Show. Subscribe to it there or follow us there. Rate the program there as well. We appreciate it. Doing our investment halftime report right now, reviewing the markets, what's driven the markets, and what adjustments you need to make to recalibrate for the second half of the year. I think one of the safe things that we can say has driven the market thus far this year is euphoria, not optimism, but euphoria over 2 letters.
Yeah, AI. Right?
Yep.
Artificial intelligence. It's like what everybody talks about when you talk about the stock market, mostly because the companies that are driving this AI revolution and this trend, their stock performance has been just through the roof. I mean, it's not like it's never been seen before in history, but certainly like so far outpacing.
It has been seen in history. I mean, it was seen in the late 90s.
Exactly.
And you go back to when Cisco had a bigger market cap than Microsoft, and then we look at what happened. Now, Cisco's still a good company, but this has happened before, and so it doesn't mean that how it's going to play out is exactly how it happened the last time. But when a company like NVIDIA has a bigger market capitalization than Apple or Microsoft, and with a fraction of the top line revenue and a fraction of the profit, it feels almost like almost like meme stocks, like and these companies, these biggest companies in the world that will move $250 billion in value in a day, are being traded like this, and that's the GDP of certain countries.
Oh yeah, a lot of countries.
Right.
Mm-hmm. So there's several ways, several things to launch off of this comment. One is that the stock market is now top heavy, almost rivaling the most top heavy it's ever been. So what does that mean? The S&P 500 is just really basic at basic level, the 500 largest companies in the U.S. So that S&P 500, you're going to own all of them. Well, do you own all of them equally, 1/500th at a time? No, that would be an equal weighted S&P 500 index, which we'll talk about. Instead, the S&P 500 is cap weighted, so market capitalization weighted, meaning the bigger the company, the bigger the market cap, the greater percentage, the greater share of that S&P 500 that you're going to hold. Josh, I think you probably have the top 10 holdings. I'm looking at the top 7 holdings right now. The top 7 out of 500 is north of 30%. So more than 30% of your S&P 500 is in 7 names. And if those names, I mean, the reason why the S&P 500 or diversification is so important is if one of those names catches a cold, it shouldn't wipe out your performance. It shouldn't put you at significant risk because you're diversified. Well, when 7 of them equal a third, and those 7 are concentrated in a similar area, now you've got some new risk that maybe you haven't been feeling.
And you've been loving it, though, over the past couple of years because those top 7 performers have been dragging the overall performance of your portfolio. Your retirement nest egg is better because of those 7 in the past couple of years. But you're getting more concentrated, which means you are facing more risk and may not even realize that it's happening because you're diversified, right? That's the whole reason you chose an S&P 500 type of a mutual fund or some other index.
Figures lie, liars figure. But Kevin, that NVIDIA has accounted for how much of the performance approximately?
Since 2022, NVIDIA is responsible for 44% of the performance of the S&P 500. So when you're tempted to think, well, S&P 500, I'm diversified, and I'm increasingly concentrated if I just own the S&P 500. There's a difference between the S&P 500 index, which is a cap-weighted index. That's the one we all look at, and the equally weighted, which means instead of owning the companies based on the size of the companies, I own an equal portion of each of them.
I happen to be looking right at a chart that goes all the way back to 1971. Actually, I'm looking at the camera right now, but now I'm back at the chart. And comparing the S&P 500 to an equally weighted index and which has outperformed. Now, guys, if you're looking at this and saying, market top heavy, I agree, I want to own these high flyers, but I also want to manage this risk. Maybe I'll have some equally weighted. You've been very disappointed. Underperforming already this year, almost 10%, underperformed last year by 12%. However, this does go back and forth. There is sort of like well, this is in favor or this is not in favor. The last time it was really in favor, though, was coming out of the Great Recession. 09, 10, 12, 13, 14, it was close, but equally weighted outperformed. The time before that was after the tech bubble. And so the question is, this is still, if you're going to play the game of, well, should I do just normal S&P 500 or equally weighted, this is you trying to predict the future. Are we at a high point and about to see a correction? That's sort of the question, and that's a gamble, guys.
Right. Well, if you said, I want to manage risk in my portfolio right now, if you've been in the regular S&P 500 index and you said I want some protection, if you went to the equally weighted index, did you say what the equally weighted index was up this year?
It's up about 5%, 6%.
Versus
about 15.
Yeah. So this is where that 15% has been driven by just a handful of stocks. And there are years when the entire market is driven by just a handful of stocks. If you didn't own those, you didn't participate. But if you said, I'm concerned and it feels a little frothy and it feels like there's a little bit of a melt up going on in the stock market, how do I take less risk? There are ways to do that.
Well, and there are ways to know whether or not the stock market is feeling frothy as well. There are metrics that we track. There's a statistic for everything in the stock market, just like in baseball.
Yeah.
But we track something called the PE ratio, which is basically saying how profitable is a company compared to the stock price that you would pay to purchase that stock. And the higher the PE ratios go, the more expensive we would say the stock market is. And those have certainly been climbing again over the past year or two. Anytime that the stock market is rallying, it's a risk that the prices are increasing faster than the profitability of those companies. And that's what causes those PE ratios, or that frothy metric, as Kevin was referring to it as, to get higher and higher. And they've actually crossed a threshold now. They've gotten high enough that it's up at levels that we've seen in the past during bubbles.
Yeah.
And I'm cautious in throwing that word out here because I'm not saying that this AI trend or the top 7 companies of the stock of the S&P 500 are too expensive and shouldn't be owned or anything like that. I'm not saying that. I am saying, though, that by historical standards, the top end of the S&P 500 is very expensive.
Yeah.
That's not necessarily true everywhere else in the S&P 500, though. In fact, if you look at, we often draw a distinction between growth-oriented companies and value investments. And the difference is growth-oriented would be like the NVIDIAs, the Microsofts, the Facebooks of the world, where they are, the stock price is higher than what you might typically think based on their current profits, but the hope is that they're investing in future profits. The future looks bright for them. Value investors, they're trying to get a bargain. Well, those bargains right now out in the stock market, they're still reasonably priced by historical standards. They're not like way overpriced. And certainly the smaller size companies also by historical standards are essentially matching their long-term averages.
Yeah. International investments also appear cheap and yeah, we're at with the S&P 500 or large cap stocks, we're at price to earnings levels that we saw right before 2022, which was not a great year. There was a pullback and near levels that we saw during the tech bubble. So we'll see where this goes. Now, what else is driving the market? What's likely to drive the market in the second half of the year, and what adjustments, if any, should you make? We've got a few for you. That and more coming up on the Wise Money Show with Korhorn Financial Group.
Okay.
All right.
Going into segment 3.
And anything else, I think the parlay between the only thing we haven't mentioned that's driven the market thus far this year and what's likely to drive the market in the second half is Fed and interest rate. So we'll talk about that and then anything else that will drive the market in the second half. So we'll pick that up, and that'll lead us into, okay, what else is on the horizon that's likely to push stocks around? Sound good?
Yeah.
All right. All right. Not a lot of bonus content. Just how we're feeling.
Not a lot of bonus energy.
Yeah. I am sweating over here
like your fever's breaking or what?
like a sinner in church.
Yeah. Well.
What are you talking about, Lindsay?
All right. Here we go. Third segment. How much? I'm sorry. All right, here we go. That's good.
Are you starting to sweat too?
No, I was about to go, and Kevin. Yeah.
Oh, blame the victim here, Mike. Come on.
That's
Oh
funny.
dear.
All right, here we go. All right, how much is the market going to be influenced by the election? We've done some shows on this before, and as we're talking about what to expect in the market for the second half, how much is the election going to drive it? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media. Wherever you're at, we are there as well. Search the Wise Money Show. One of the themes that has kind of driven the market thus far, at least halfway through the year, is likely going to continue. And that is, what in the world is the Fed going to do with interest rates? Now, top line CPI has come down, and yet we're all looking at grocery store prices and all of that, and it seems that prices are continuing to go up. And so, okay, so this is the summer. You guys know I moonlight as a baseball coach, and so I have the unfortunate responsibility of telling all these parents how much it's going to cost to go watch their kids play. Yes, you heard that correctly. These tournaments charge fees to enter the park, and it's outrageous.
Oh, wow.
And these prices are up They're not double from last year, but they're up considerably from last year. And then they tell you, oh, by the way, cash only. Oh my goodness. So inflation is still there, and so the Fed is trying to determine, well, when can we start lowering interest rates? The Fed, at the beginning of the year, the market expected the Fed was going to drop rates 6 times this year. Guys, that would be a very steep recession in order for the Fed to drop rates 6 times. Well, they haven't dropped them at all yet. And you would think, well, if the market thought 6, and thus far the Fed has done 0, I bet the market's done terrible. It hasn't. The Fed, every time that they've said we're going to keep interest rates stable, they then go on this campaign of trying to appease the market. But everything's good, and we'll be reducing rates soon, and everything's okay, and blah, blah, blah.
I don't see stag, and I don't see inflation.
Yeah, right. And so the Fed has certainly helped influence the markets thus far this year. And I think they're in the driver's seat of what's going to influence or what's going to drive the market for the second half as well.
Well, I mean, all eyes have been on these statistics related to inflation, though. And, we could debate, we could do entire shows about how much faith you put in the data coming out of the government, out of the Fed, that sort of thing, especially regarding prices, because you and I, we live it every day, right? We know what our gut's telling us, and it doesn't always match what the data is showing necessarily. But when we look back on the data over the past 50 years, inflation has actually averaged about 3.8%, and we've just now dipped below that point. So, certainly the Fed has some credibility in the sense of they can point to some kind of numbers, and as long as those numbers are the same numbers they're always pointing to, then you can see trends at least, right? Mm-hmm. Again, we could debate on how reliable the data is, but the fact that things are back down to the long-term average, but now keep in mind that long-term average is driven higher because of the late 70s and early 80s when inflation was just through the roof. When we compare where we're at today to what we have known over the past 20 plus years, when inflation was just almost non-existent, it still feels painful out there.
Yeah, and if just to report, I mean, I know we're all still saying inflation's high. When you look just at the numbers, we had 1 year of a spike compared to the late 70s, early 80s, where it was several years where it was significantly elevated. So here's the deal. The Fed has been, so the Fed basically, in layman's terms, they can make the economy harder or slower or more expensive and more like weaker, or they can make the climate better. Like they are in control of the thermostat here.
That's right.
And one of the levers, one of the buttons that they can push is, well, we're going to turn interest rates up or turn interest rates down. They've kept interest rates up, but that doesn't seem to have slowed down the economy. GDP does look like it might be a little bit more tame or muted in the second quarter. We'll see that in another week or so. But that's one of the things that they're doing. The other thing that they can do is they can increase or decrease the money supply, the amount of money out there floating in the economy. Now, that certainly is what determines inflation. Well, they printed so much money during COVID and thereafter, and right after COVID, it's safe to say we are in uncharted territory, and no one really knows exactly how this is going to play out, including them. The Fed has been trying to pull money back out of the economy. But guess what? Guess who isn't? The Treasury. The Fed and the Treasury, this is so confusing. The Fed and the Treasury are not the same. The Treasury is running a deficit, right? As a country, we're running a deficit. We still, where's that money coming from? It's got to be created. In fact, there is a Treasury slush fund right now as well that at the exact same time that the Fed is pulling money out of the economy, the slush fund in basically the checking account that the Treasury has is going down, meaning they're injecting money into the economy.
I thought you were going to say the credit card that the Treasury has.
Right. So this is this sort of complicated misnomer that the Fed is sort of saying we're being hard on inflation, we're keeping interest rates high, we're pulling money out of the economy, and yet in the shadow of the Fed, the other side of the government is just spending like crazy.
Yeah, spending like crazy. And there are some other confusing things too. Where they're borrowing at 3 months, which is more expensive than 10 years. So, and Janet Yellen was even asked about that. We're also borrowing money to pay off our debt. It's almost like having a credit card and then getting a cash advance from one credit card to pay another one. And so it's very confusing if you look at this and you say, what do I need to do? And as far as I can tell, the solution to this is to own assets.
Yeah,
own high quality assets.
During 2020, okay, this is I'm going to take you back, and all of this money was being printed, and we had very violent markets, the quickest bear market ever, and then the best 50 days in the market ever, and the second best 100 days in the market ever. So we had violent markets, and this was due to COVID shutdown and then this surge in money printing. Well, at that time, we introduced you to a concept called the Cantillon effect. I think it's a Robert Cantillon, I believe, economist out of Europe, who basically said when the government prints money, they might have really good intentions, and we're going to print money and we're going to put it right here, this specific pot, and they don't have any control over that. Mm-hmm. It's like honey slobbed onto an ice cube tray. Give it enough time, and that's going to raise prices for everything. It will influence everything. But in the short term, that honey is slow moving. And where's that money going? Into the financial economy. It's going to increase prices of assets. That is, like, even if you have noble intentions, when you print money, asset values, asset prices will go up. I just heard this recently. The average house in the U.S., the average house since 2020 has increased about 46%. How much has the money supply increased since over the same time?
And this is a good one to think about. So catch what Mike just said. Average house price up 46%. Money supply has increased
about 42%. So your house is not worth more.
It just costs more dollars. The dollars are worth less.
Yeah.
And if you talked, I was actually at a picnic last night talking with a friend who has a place in Florida. And he said, I quizzed him with this statistic. He's kind of a geek too. And I asked him, what have home prices gone up in the last 5 years? And he said, about 110%. Because that's what it's done in his...
See, that's what I would have said.
Right.
Well, yeah.
I would too. So, but if you even going up 50%, I mean, this is the difficult thing. Affordable housing getting more and more out of reach for lots of people.
Oh yeah, absolutely. Okay, so we're gonna bring this all down to earth. What does that mean for markets? What does this mean for you? What adjustments should you make? And by the way, with an election coming up, is that going to influence anything? So recalibrating, what is your investment approach? What is your investment philosophy? And on the heels of what we've said, the market has surpassed expectations thus far this year. It's at levels that are now frothy, using Kevin's term. And we have this experiment going on with our monetary policy. Therefore, what should you do and how should you plan? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Please tell me that wasn't the fourth segment, right?
Right.
Okay, no. So good. We can talk about that. Well, that's what we're going to talk about for 10 minutes. What do you do? So do you run for the hills? Don't own assets. Yeah, but you told me I can't own bonds either. So what do you do?
Yeah, I think my favorite part of that last segment was you said honey globbed onto an ice cube tray. It raises prices.
No, so
and I'm thinking
that's exactly right.
Direct quote. Actually, I heard it.
Okay.
I was here.
I'm thinking, okay, that's it. I am no longer globbing honey onto ice cube trays because I do not want higher prices.
Get the T-shirt. Get the T-shirt. No, so it's going to land basically on financial assets. So it's going to raise housing values, the value of a company right? So as opposed to, okay, a rising tide lifts all boats. No.
Right, not equally.
Businesses, assets just got more expensive. Before you saw more money in your bank account, before you saw more money on your paycheck, everything just assets got more expensive. That was I didn't tie that together. I think it was clear. Yeah. Here we go.
We'll give you a do-over next week.
Thank you. Thank you. All right. Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it there. Turn on notifications so you're made aware every time we drop new content, which is not just this talk show, but lots of other content all throughout the work week that we deliver for you, all to help you take your next wise step in your financial life. So go to YouTube, search the Wise Money Show, subscribe to it there. Okay, time to turn our attention, guys. What do you do with all of this? We've mentioned market's done well, surpassed expectations. We've got this huge controversial election coming up. We are in this grand monetary experiment called modern monetary theory, and asset prices are high. That was the guys were teasing me for not finishing the honey ice cube tray example, and essentially what that means is it immediately asset values went up. Immediately, home values went up. Owning a business, i.e., the stock market, went up. Anything that was an asset, your vehicles went up before you had more money in your bank account, before your paycheck went up, before a lot of other things. These asset values or prices went up. So what do you do? What do you do?
You stay the course. You own assets, and you realize that what's happening is it's confusing because you think, well, things cost more, and it's not that things cost more. It's that your dollars are worth less. And I'm not saying that to be a joy killer or, a wet blanket here, but you just have to realize that's happening. So if my purchasing power is eroding, I want to be strategic in my financial plan to own an appropriate amount of assets without having an inappropriate amount of risk. And that's possible.
Yeah, it is. In other words, don't overextend yourself trying to buy these assets just because you want to jump on the bandwagon. I've got to be a homeowner because look at how homeowners have benefited over the past couple of years. What would you say, 46% is the average increase in homes over the past year?
Home values.
No,
since 2020.
2020. Okay, since the pandemic there. But that's a short amount of time, a lot of increase. And for a lot of people, not necessarily, they didn't necessarily experience that kind of an increase in their paycheck or their ability to handle a mortgage. If you haven't purchased a home yet, has your down payment fund grown by 46% over the past 4 years? Maybe not. But to me, you could get just sort of paralyzed by focusing on all the things that are outside of your control.
Yes.
Right? Like you don't get to choose what the Fed is going to do next with interest rates. Are they going to bring interest rates back down so that mortgage feels more affordable for you when you do buy a home? Is there going to be some sort of economic pullback that brings house prices down so that it's more within reach for you? You don't get to control these things, but you do have things that are within your control. And I'm not even just saying influence. You have control over what you spend. You have control over how much margin you build up in your normal monthly budget. And what do you do with that margin you have control over? You can save it. You can invest it for the future. You can make a wise choice. You could pay down some other debt to free up cash flow. There are moves within your control if you have the right game plan in place. And so if you're wondering, well, what do I do with the investment world and what it's throwing at me right now? The answer is always go back to your financial plan and focus on the things that are within your control. And if you need help with that, then this may be a time for you to seek the help of a certified financial planner who can, get into the situation with you and help you understand what are your options, where do you have control.
stay the course. So said that, and we're going to come back to that. Completely agree. And tune into your plan to make sure that you're on track and dollars that, even considering updating your budget or managing your cash flow and making sure that those dollars are used to help improve your financial plan. I would also argue that, you need to own assets, but know that those assets might behave a little bit more volatile, in a more volatile way, both on the upside and on the downside, simply because, again, this is sort of a grand experience. This is uncharted territory with how much money we've printed. And so your diversification is more important, but traditional diversification, I don't think pulls it off anymore. I just don't. So just saying, well, I've got large U.S. stocks and mid cap and small cap and international and bonds. See, I've got eggs in different baskets. I don't think that is enough. Mathematically, when risk goes off and you say, see, no, I've got different baskets, my eggs, some of them should be protected, they're all going to look and feel the same. So you need to have multiple strategies within your investments. That's got to be part of your diversification, that you're using multiple strategies so that you do have truly eggs in different baskets.
If you are in the accumulation stage of your career, you're earning and setting aside money for a long-term goal like retirement, I want to encourage you right now to tune into what are your non-negotiables. What are the activities or the habits that you won't interrupt just because the stock market has some sort of volatility? And in fact, I would say that your steady contributions, the money that you are trickling into the stock market, into mutual funds, into your 401k at work, wherever it's going, that habit is something that you want to just resolve in your mind during these good times. When the storm clouds come again, when the volatility is working against you instead of for you, I'm not going to stop my contribution mode, because those contributions during a dip are the most powerful buying opportunity that you have. And they come around every so often, and they're scary every time they do. And often they drive people off their game because they think they're just throwing money down the drain, when in reality, you're finally buying at great bargains, and you should be increasing your contributions, not decreasing.
And that's where, Josh, you said, we'll focus on what you can control. And when the stock market goes down, what can I control? I can control whether I'm putting money in or not. Mm-hmm. And you wouldn't believe how many folks will reach out and say, hey, can we stop the contributions right now when the market's down? I can't take it. No, that is within your control, but that's not the thing that you should be focusing on.
Yeah.
And you talk about a time when your financial coach matters, right?
Yes.
Because you're wanting to do one thing, and what's best for you in the long run is a different thing. Who's that voice in your life who is helping you to stay the course, remember what you already decided, and stick to the game plan?
A simple way of doing that, I use that term lightly, is rebalancing. Mm-hmm. Now is a time where hopefully you have an automatic rebalance schedule and you don't need to think about it. But if going back to that traditional diversification, where you've got a percentage in large cap, a percentage in mid, small, international. Well, earlier in the program, we shared with you how large cap, once again, has outpaced just about everything else, which means if your recipe is calling for 30% large cap, it now might be 32 or 33%. Your small cap, instead of being 10, might be 8 because it's underperformed. Well, how can you sell high and buy low is to have that rebalance, just a discipline where you trim off some of those gains, some of that frothiness, and reinvest it into an area that cyclically maybe hasn't performed as well. So tuning into your rebalance schedule halfway through the year is typically a great time for that to happen, and make sure that you're rebalancing.
There may be some temptation this year to have some kind of reaction to what happens in the fall during the election as well.
Yes.
And this would be another place where you have to resolve in your mind,
Fight it.
I'm going to have a game plan that is going to make sense regardless of who's in the White House, who's in Congress, any of that. Regardless of what the outcome is, whether your team's jersey's hanging in the White House or the other team, it doesn't matter. The long-term game plan is what you need to be sticking to, and that's irrelevant of the next 4 years.
Yeah, I would expect maybe some volatility. Again, we've only seen a 5% pullback in the market thus far. That is unusual. So maybe expect more of a pullback, especially going into the uncertainty of what's going to happen in November. And then history shows that whether that's an election rally or a Santa rally, from the election to the end of the year, markets tend to perform well. And so just expect that volatility and stick to your long-term game plan. Work with your CFP. Do you have the right investment allocation for your financial plan? Are you taking the right level of diversification with different strategies? Work with the CFP, who's a fiduciary in your corner, helping you with your plan and helping ensure that your investments are connected to that plan. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.